Welcome to the C Corporation Basics mini lesson with Teaching Tax Flow. I'm excited to talk about this subject with you, as a C Corporation is the only entity type in our Teaching Tax Flow Entrepreneur course that is subject to double taxation and doesn't have the profit and loss from the entity eventually flow on to the owner, member, proprietor, or partner's tax return. There are some advantages to a C Corp, so we're going to talk about that: formation, management, asset protection, taxation, reporting, fringe benefits, IRS guidance, and then some calls to action. With a C Corporation, there are a lot more formalities with a C Corporation than a sole proprietor or a partnership or even a limited liability company. It does require filing formation documents with the state taxing agencies, but it also requires a board of directors, officers, and annual reporting requirements. Most states do require annual meetings and bylaws. Now, the thing with the C Corporation is one person can typically, especially if you're a small business, play multiple roles, be on the board, be the officer. In larger corporations, will have more people on their board of directors and more officers. They can have one shareholder, but an unlimited amount is permitted. So with an S Corporation, you're limited to a certain amount of shareholders. C Corp, you have an unlimited amount of shareholders. Capital is raised by the sale of stock. And then, unlike partnerships and LLCs, the entity existence for a C Corporation is perpetual. So that's a really nice advantage. This type of entity is best for owners that want company-funded fringe benefits, liability protection, and corporate tax rates. We talked about that double taxation. The nice thing about a C Corporation is, for many taxpayers, the C Corporation federal tax rate is actually lower than their personal tax rate. So if earnings are retained in the corporation, they're actually paying less overall tax. The other thing we talked about is liability protection. As you know, Teaching Tax Flow is not a law firm, so we definitely want you to consult your legal advisor, which shareholders are typically not personally liable for the debts of the corporation. Now, taxation, as I mentioned, this is subject to double taxation. So that's something to be very wary of, that if you have a profit in the corp, you're going to pay tax on that in the C Corp. And then whenever you take funds out of the C Corporation, be it W-2, dividend, rent, that's taxable to the shareholder. Every year, C Corporation files a Form 1120 that is due on April 15th. You can easily get a 6-month extension. We're going to take a peek at that tax return. The bookkeeping is much more complicated, and you need double entry bookkeeping for a C Corp because you are required to file a balance sheet. The cool thing about a C Corp is the entity can very easily operate on a fiscal year end. Shareholders can be employees and eligible for excludable fringe benefits. We mentioned that that's a real nice advantage of the C Corp. Reasonable wages must be paid to shareholder employees. We're going to have some additional content about reasonable compensation. And corporate losses cannot be deducted by the shareholder. So just when you have that loss on an S Corp or an LLC, a lot of times a shareholder can deduct the loss against personal income. With the C Corporation, that loss stays on the corporate tax return and cannot offset shareholder income. We're looking at a Form 1120. This is that C Corporation tax return. Keep in mind that if you have a fiscal year end, you're going to look back when you file that return. You're looking at page 1, and then obviously that balance sheet also has book tax reconciliation. But again, C Corporations do not file K-1s. So any profit from the C Corp, the tax is paid by the corporation. That could be a good thing, or that could be a bad thing. Publication 542 really lays out corporations, and if you have a C Corp, we highly recommend you work with a qualified tax professional. The other thing is Circular E. Typically, corporations are more likely to have employees. Publication 15, Circular E, right here, really lays out an employer's tax guide, because when you're paying employees, there's a lot of responsibility that comes with that, and you need to be aware of that. And many corporations do have employees. All right, let's wrap it up. If you have a business or looking to start one, a C Corporation might make sense. So definitely review our business entity type and check that out. If you have employees, make sure you review Circular E. And we highly recommend here at Teaching Tax Flow, outsourcing your payroll and human resource functions. Those are such dynamic functions. There's a lot of risk and there's a lot of paperwork that I personally like to outsource those functions. advantage with a corp is those excludable fringe benefits. So definitely use those to legally and ethically reduce the tax, income tax and payroll tax you pay. If you're a C Corp, it might make sense to make an S Corporation tax election. We have a separate mini lesson specifically on S Corporations. Definitely talk to the people on your board of directors, your attorney, and your tax advisor. Finally, always consider those state-specific tax laws when it comes to C Corp taxation. Thanks for watching. Have a great day.
John here from Teaching Tax Flow. I wanted to thank you for watching this video. We literally have hundreds of hours of content between podcasts, webinars, videos just like this built specifically for you, the taxpayer. Whether you're a full-time employee, you're a freelancer, you're a contractor in some other sense, or you're thinking about getting into business for yourself. Everything here at Teaching Tax Flow is perfect for you, basically going off of the roadmap provided by the IRS to legally and ethically reduce the taxes paid over your lifetime. So be sure to subscribe to this channel and connect with Teaching Tax Flow, and we will see everybody very soon.